Welcome back to the What's More podcast. I'm your host, Quinton Harris, as we're back for episode 153. And in this episode, we're going to talk about why point one has everyone so rattled. And what I mean by that is the CPI reading that came in and what the impacts and effect of that are right now on the economic outlook of the economy, more importantly, mortgage rates. But there's some good news in this, and I'm going to talk about what that good news is, and I'm going to talk about why the glimmer of hope is becoming brighter, and the hope being mortgage rates and real estate improving because of this. And I know that's hard to believe, but it seems like the whole country was losing their mind over this 0.1 beat, if you may, and beat meaning the inflationary index that came in was up by 0.1. It missed expectations by 0.1, but I mean, literally people were losing their minds. The bond market went crazy, the stock market went crazy in a bad way. And the reason for that is that, you know, if you're in the bond market, your job is to anticipate, I shouldn't say your job, but what you think you're going to do is anticipate the Federal Reserve's movements. And because of that, you were the group that came out and said the Fed's going to have 6 rate cuts on the year. Like, the Federal Reserve never said they were going to have 6 rate cuts on the year, but the bond market said that, issued that, priced it in. And when the Federal Reserve doesn't meet expectations, the bond market retreats. And that's what we're seeing happen here. Same thing on the CPI expectations, over 0.1. And so I take a look at that, and the big uproar is the rent question, right? When you look at the CPI, which is, you know, the consumer price index, what's going on here and affecting everything is a term that if you've been listening to our show, we've probably talked about this a million times, but I'm going to beat a dead horse here, is shelter cost. And everyone seems to be in uproar over the rent readings. And the rent readings are the owner's equivalent of rent. And yes, while it's a big deal, it's really a flawed system. And I mean, I think about it when I look at it this way, as a listener, if someone was to call you, which is essentially a survey they do, and say, hey, what would you rent your house for? You know, are you going to underestimate what you think that home should be rented for? Or are you going to say, well, I wouldn't rent it for less than this? Of course, that's the answer. And that's what they continue to get in these readings. And quite frankly, shelter cost makes up a significant amount of the CPI. Now, there is some good news here, and I'm going to talk about that. The Federal Reserve doesn't really pay much attention to the CPI. And I know there's a lot of acronyms we throw out on this show, CPI being Consumer Price Index, the PPI being the Producer Price Index, and then there's the PCE, right, the Personal Consumption Expenditures. Now, that's the one the Federal Reserve pays attention to. So this PCE is the big one. But this CPI has kind of caused some ruffling of the feathers, if you may. And a lot of it has to do with the reading coming in, like I said, at 0.1. The headline was 3.5, and the core reading, when you take out food and energy, was 3.8. Now, we know the target rate of inflation for the Federal Reserve is 2%. So having a 3.8 at the core is not attractive. But again, good news. Federal Reserve does not pay as much attention to the CPI as they do the PCE, because the PCE is the target rate that they look at. So let's take a look at this. This is from our friends at MBS Highway. And what you're going to find is they break down, how did we come up with this? What are the weighted averages of the CPI? And inside of this, what you're going to see is shelter cost, which is a combination of rent, basically lagging rent indicators come in, that owner's equivalent of rent. That's that, hey, what would you rent your house for type question. And then the lodging away from home, right? This is when you go to like Airbnbs, hotels, travel, leisure, et cetera. That is a 45% reading of the core index. So it's very weighted heavy. It's almost 50% of the whole reading. Well, that's up or it's unchanged. And when that happens, what you're going to find is that reading's not going to come down like it should. And so again, when you take a look at the owner's equivalent of rent was up. Hey, what would you rent your house for? That number's up. And until that starts to come down or stabilize, we're going to continue to get these readings in this consumer price index higher than what we're expecting. So the reaction from the market was bad, and it's just a tiny miss, man. We're talking like a tiny, tiny miss here, not like a home run, like a tiny, tiny miss. And yet the market overreacts. Now, what we're finding is this came out on Tuesday, came out on Wednesday, and then on Thursday, the Producer Price Index came out, and it was favorable. It actually met expectation, was a little below. And what's great about that is that filters down into the PCE. So maybe we're getting an indication that the personal consumption expenditures is going to be favorable based on what we saw with PPI, because it filters into there. That's a positive thing for us. But again, the uproar that happened on the day in which this came out was not great for us, right? The bond market rates were basically impacted worse by this than anything. And we're starting to see a little bit of retreat. But this is all just a complete overreaction. And so one of the things we look at on rent is, how do we get real-time rent? Like, I don't think picking up the phone and calling someone going, hey, what would you rent your home for, is real-time rent. So Apartment List sends us real expectations of what our rent renewals are. So we get renewals each month from Apartment List, and they send out a letter and said that they fully anticipate and expect renewals that are coming in to continue to go down or stabilize at best. And I think that that's a positive indication. But the challenge with that report is this: we have 3 months, right? We have January, February, March. We already have the first 3 months of apartment renewals, and those are up 1.5%. And so they're forecasting over the year it wouldn't be any higher than 3.5. Well, unless something dramatic changes there, we're going to be above that 3.5. We're on track to be at 5.5. So it would take a dramatic change of rent rolls for that to come down below the expectation 3.5 there. But again, all of this is weighted extremely heavily on the CPI, not the PCE. And again, I continue to say, that's what the Federal Reserve is going to look at and measure their target rate of inflation versus these CPI numbers. And for whatever reason, the market puts a tremendous amount of weight in the CPI, which doesn't make sense because the Federal Reserve is looking at a completely different index and indicator. So maybe one of these days those two will get on track. But as of right now, those are two different indicators having two different point of views. And traditionally, there's always this gap between, historically, there's a major gap between the CPI and the PCE. And it's there clear as day right now. And, when you take a look at this, one of the things that I would say if you were a mortgage housing professional, Wednesday was not a great day. If you're a real estate agent, Wednesday was not a great day. Why? Because if things remain the same at the current outlook in which they are as of Wednesday, and when I'm recording this today is Friday, or the 12th of April, you basically had a rate cut taken off the table. That's what happened. The CPI basically took a rate cut option off the table. So you went from 3 to 2. It doesn't mean they won't cut rates in June. It just means that it looks like it went from 3 to 2. Now, what could happen is that the PCE comes in at expectations and remains with a 2 handle on it, and maybe that rate cuts back on the table. But as of right now, until we get that PCE reading, that is what this is. And that's a gut punch for the mortgage industry. It's a gut punch for real estate agents. It's a gut punch for the consumer, because we need that rate cut to help alleviate all of the problems that we've been discussing on here. However, as I said, PPI came in on Thursday and it was favorable. That is a kind of an early flash in the pan, if you may, of what we may see in the PCE, because again, those costs from the producer price index, if you recall, like if I'm looking at my phone, how much does it cost to make this phone? How much did it cost Apple and the vendors to build this? Did that price go up or did it come down? Well, it came down, so that's a win, right? And that number filters back into the PCE. We could get a favorable PCE there, and that's a big win for us. But here's the canary in the coal mine, if you may. Here's the one glimmer of hope that I've been tracking. And if you've been listening to our show over the last year, something that we've been talking on here, especially with Daniel Halverson over and over again, is the spread between the 10-year treasuries and the spread between the 30-year fixed rate. And you remember we did a whole episode where the NBA wrote a letter to the Federal Reserve, and that's the Mortgage Bankers Association, and said, hey, listen, these spreads have become a problem. And the spread is so unbearable that it's actually hurting the first-time home buyer and the consumer. And so traditionally speaking, if you recall, just do a quick recap, the number on the 10-year treasury is representative of what the yields are on the 10-year. But you should be able to say, okay, I'm going to add a 1.5 or 150 basis points, and that should give me a quick outlook of what a 30-year fixed-rate mortgage should be, because traditionally speaking, that's how those two trend. Now, let's say today, this is not right, I'm just using an example. Let's say it's 4.5. Traditionally speaking, I should be able to add 1.5 to that, and 6% should be my target rate for the 30-year fixed rate. So hopefully that makes sense. Well, ever since the banking crisis and early into 22, the spreads, because of the market uncertainty, have become more like 3.25 instead of 3.5. And if you go back to 22, you'll be able to see at higher yields of the 10-year currently, back then, we were closer to 8% interest rates, and those spreads were about 3.5. So what I've done in this chart, I did a spread from basically 2019 all the way through current market. And what I'm showing in this chart is why the spreads are getting better. And we've been talking about that it doesn't take the Federal Reserve lowering lowering the Fed funds rate for interest rates to get better. And this is the glimmer of hope. It's literally right here in front of me as I'm going to show you guys this. So the 10-year treasury as of yesterday closed at a number that's about just shy of 4.6. So if you were to go back to 2022 when we were at a 4.6 treasury, we were almost at an 8% mortgage rate. Yesterday we closed around 7.25. So the evaporation of that spread is starting to happen. And so why is this a glimmer of hope? Well, because yesterday, if you're, again, going back to bigger spreads, we should have had higher rates, and we didn't. We were able to maintain those rates at current market conditions. So what that means is this. As the 10-year treasury starts to retreat, and it will retreat, here's the good news. you're going to see the sixes come back on the board much quicker. And you might even see that sub six that we've all been looking for much quicker because the spreads are starting to evaporate. And I think there's still more room to go in this as far as the spreads are concerned to get back to that 150. We may have gone from like 3.25 spread down to about a 250, but we still have a good amount to go till we get to normalization. And that's starting to happen. So the more stable the market becomes, the more, I guess, less overreaction we have in the market. That's going to help. And, here it is Friday, and we're already seeing corrections come back from that overreaction. And that's very typical. So there is good news in this report. There is not as much of a freak out that needed to happen from a 0.1 reading. And, the good news is this: sixes are on the way because these are going to come back down. So as they do, mortgage professionals, keep your head up. Real estate agents, be prepared. The sixes will be back on the board sooner or later, and we don't need a Fed rate cut for that to happen. So if you guys like what you're hearing, please share this with your friends and family. Please take this podcast on any platform you listen to. Give us a 5-star review, and ultimately check us out on our YouTube channel at What You're One More with the number 1. And all the graphs, all the links, everything will be in there for you to check out. Till the next episode, we'll see you at What You're One More.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.